We're going to take a close look at fixed indexed annuities. Fixed index annuities. I hear a lot about these products from people, salespeople in particularly, who say fixed index annuities will beat the market or do this or do that, and without any risk. And I shudder to think. I had a guy on this actually Advisor Perspective, and he was like saying, yeah, basically he was guaranteeing that fixed index annuities would do better than bonds and probably better than market. What is that? If any fiduciary licensed advisor were to say that, they'd lose their license. You can't say that. But anyway, that's the drawback about the insurance industry relative to the investment industry. The investment industry has to watch what they say. The insurance industry can say pretty much what they want, which is anyway, I don't want to get at that. So in this case, we're going to use the Advisor Perspectives website. Michael Edison and Robert Hoopshire, who I think Hoopshire, I'm probably not saying his last name right, but I think he owns the Advisor Perspectives website. I'm a huge fan of Advisor Perspectives, perspectives.com. You should be too. Just the guys who write on this are just absolutely wonderful. We got Michael Edison writes on this. We got Joe Tomlinson, Alan Roth, just a number of guys write on this website. It's just fantastic. And when they write, it's very informative, and it keeps me on my toes because they write good stuff. So let's dive into this. And then we're going to, on part 2 of this series, we're going to look at they're going to look at Roger Ibbetson's promotion of fixed index annuities. So we're going to dive into that. So this is kind of the con, and then we'll look at the pros of FIAs and see how that shakes out. Remember, I'm just telling you right now, I'm going in this with a somewhat hesitant perspective on fixed index annuities. It seems to me the sales pitches I've heard, it gives you market-like returns with no risk. And the thing that drives me crazy about that, they're not explicitly stating what the market is for their market-like returns. They're implying it's stock market. Folks, you cannot get stock market returns without stock market risk. It's literally that simple. If you want the returns of the market, you need to be in the market naked, so to speak. That means with no insurance protection, or else you cannot get market-like returns. There's just no getting around this. We've been talking about this for decades now. In the 80s, they used to have this thing called portfolio insurance, and this exact same scenario with fixed index annuities, with variable annuities, with all these different hedging strategies, give you upside like the market with downside risk protection. It doesn't work like that. If you are market-like returns, you are inherently sacrificing something from the market. I just got to be clear on that. And anyone who says otherwise is either ignorant or they're lying. There's just no getting around that. No getting around that. If you want market-like returns, you have to be in the market. It's all that is there to it. So let's dive into this here. It's a pretty big article, which I like. And again, I'll put the link to the show notes. You can subscribe to Advisor Perspectives. You don't need to be an advisor. You can read all their stuff, and you absolutely should. And of course, if you like what you see here at Heritage Wealth Planning, subscribe down below. Hit the button to be notified for future, the little bell there. And then, of course, comments to share this video, and thumbs up always help me as well. All right. So Michael Edison is he's an a mathematician by trade. Not sure what Hoopshire's, he's just been around for forever. I've read tons of his stuff. But Edison is a mathematician. I've actually taken umbrage with a couple of Edison's posts, actually. He's very fanciful on math when it comes to financial markets, and then he doesn't challenge the science behind the math behind climate change. Is odd to me. And I always said, wait a second, how come you can tear apart our industry for the lack of financial or mathematic know-how, but then when it comes to the climate change, Michael Mann hockey stick fraud, you're completely okay with that? It's just odd to me. But be it as it may, from a comes financial planning perspective, he's spot on. And so we're going to talk about this. The market for fixed index annuities, FIAs, previously known as equity index annuities, is growing rapidly with sales of more than $60 billion annually. We did a careful analysis of 2 products that are available on the market. Our conclusion is these products are not bad choice for an investor who is extremely sensitive to loss of capital, but a simpler do-it-yourself alternative better. We caution against extending our conclusions to FIAs in general. Our analysis was limited to 2 products that were the basis of a recent research done by Roger Ibbetson. Those products have higher costs than FIAs in general, and those costs adversely affect their performance. So let me give you a little bit of background on Ibbotson. Ibbotson, I think he's out of Chicago, the Ibbotson Research, and they do this chart. Every year they put out this thing that shows bonds, stocks, cash, and inflation or something like that. That's been around forever. And that was actually the basis, I think, in 1993 or something like that, and maybe in 92. I saw the Ibbotson chart and I said, man, that, because it just compares compounding over time, the dwarfing of stocks relative to bonds and cash. It was really just opened my eyes. I said, wow, that's interesting. So Ibbotson's got some chops in this business, that's for sure. A lot of respect for Ibbotson. That's why it's odd that Ibbotson came back to voicefully, whatever, full throttle on the fixed index annuities, because we're like, it seems odd. But anyway, let's go into it. Explanation of fixed index annuities. Although the details vary and optional riders are available, that further complicates the product choices. And we're not going to consider the riders in this investigation. FIAs have certain common features. Those features are governed in part by the participation rate, the cap, and the surrender fees, each of which will be explained. The main feature is that the FIAs guarantee the paper value the investor account will not fall below at a minimum. Most often, that minimum is the amount the investor originally put into the account. Thus, the investor is guaranteed never to suffer a loss of principal. At the same time, the investor participates in a percentage of the growth of an equity indexed annuity, such as the S&P 500. I'm sorry. I was looking at my clock, so I want to make sure I cut this up at the right. I don't want to go on for 40 minutes on this one video. At the same time, the investor participates in a percentage of the growth of an equity index, such as the S&P 500. Many other indices are available according to an industry source, more than 100. For an example, an investor might gain 50% of the growth of the index. This percentage is called the participation rate. So if the index goes up 100, you get 50%. That's your participation. In the case of an FIA index to the S&P 500, the investor usually participates in the growth alone and not in the dividends. And everyone overlooks that. I'm telling you right now, you should not. And I'll do another video again on the Investment Company of America's mountain chart. It's nuts when you factor in the dividends. We emphasize that as the paper value that is guaranteed not to have declined or not declined below preset minimum, but by the end of a certain fixed sub-periods of the term of the annuity, for example, 2 or 3 year sub-periods. The reason for this emphasis is that during the term of the annuity, the entire paper value cannot be withdrawn without paying a surrender charge. And they're using a 12-year surrender charge, which a lot of these FIAs, fixed index annuities, have. Long surrender charge. Their surrender charge generally declines annually until it's at zero at the end of the term of the annuity. Again, usually a significant amount of time. At this point, the paper value can be drawn without penalty. Now, the paper value, again, is your initial deposit. That's what they're saying we're going to guarantee you. Now, I want to say a couple of things. Everyone hates surrender charges, and I actually disagree with that in some regard. The benefit of long surrender charges is it will keep people in the product. The hardest thing with no-load funds in particular is that will encourage bad behavior, i.e., this fund's doing crappy, so let me jump in that fund. All of a sudden, that fund's doing crappy, let me jump back into this. And I'm telling you, my man Meb Favor from Cambria Investments talks about it. He would love to be able to bring to market a product that says you can't have access to your money within 10 years. You can't. With no ifs, ands, or buts. And going in, you can't have access to it. And he says, and I agree with this 100%, that product would probably outperform the vast majority of stuff that's out there for most investors because it eliminates your ability to jump back and forth. All right. Thus, the net result is that the value of the annuity that can actually be fully realized is guaranteed not to be less than the preset minimum only at the end of the term of the annuity, 10, 15 years, whatever the surrender charge is. On the upside, the value may be as much as the participation rate times the gain in the price of the index. So again, the index is up 50 and you're at a 50% participation rate, you're going to be up 25%. In addition to the return of the principal paid to purchases. So in that case, you put $100 in, your participation rate was 25% or $25, you'll get $125 back at the end of the annuity. The walk away money is what I call it. Whenever you're looking at an annuity, always ask what the walk-away money is, not the income stream, the walk-away money. How much can I get for a check at that time when I want to walk away from the account? Nothing else matters when you're talking about your principal and your ability to have liquidity. What is my walk away money? Every agent out there knows what that means. Do not get sucked into thinking, oh, you're guaranteeing 7%. Is that a guarantee for walk away money? It's not. I'm just telling you right now. All right. However, some FIAs come with a cap on the amount that can be realized from participation in the rise of the index. All right. So the Ibbotson study. So Ibbotson is a Yale emeritus professor who's chairman of Zebra Capital, an investment management firm, and has done a study on the FIAs. We're going to talk about this article next. That's been cited a lot by the financial media. The chief conclusion cited is that a simulation showed that over the 90 years from 1927 to 2016, the FIA's annual rate of return would have exceeded that of a bond portfolio by about 0.5%. In other words, FIAs were a superior investment to bonds over a long historical period. A deficit of the Ibbotson study is that it analyzed a hypothetical FIA, not one that is, or to our knowledge, was actually on the market. A hypothetical FIA might be even superior to one that can actually be purchased today. The hypothetical FIA could have been engineered to make it look good compared to alternatives, especially if the designer had an interest in the result. The only way to tell if the FIA could have been that one would have been one that would have been offered by an insurance company would have been to test whether it is profitable for the offerer as well as the investor. Unfortunately, that was not done in this study. Also, in the Ibbotson study, there's some opaque features of a hypothetical FIA, making it difficult to replicate or check. For example, it uses dynamic participation rate. Instead of the investor's participation rate and the rise of an index being a fixed number, again, using a 50% participation rate, for example, it changes over time, according to a formula that is explained in principle but not fully revealed. The changes in that participation rate generated by the formula are, however, shown in a graph in the Ibbotson study, making it at least possible to estimate what the average participation rate was. The Ibbotson study was not underwritten by any insurer or issuer of FIAs, fixed index annuities, according to disclosures in the study and in our email correspondence with Ibbotson himself. However, Ibbotson acknowledged that he received input on the study from employees at Gen Development, LLC, and Annexus, as well as Genesis Financial Development, Inc., an actuarial firm. Gen Development is a partnership between Annexus and Genesis Financial Canada. Genesis helped create the first fixed index annuity in 1995 and works with Annexus today in product development, research, and marketing. In addition, Ibbotson's firm, Zebra Capital, earns royalties by licensing its indices to Annexus. So it's reasonable to assume that Ibbotson was financially incented to present a favorable view of fixed index annuities, even if his study was not actually underwritten by them. It also helps to understand a bit of how FIAs are marketed. FIAs are normally produced by an insurance company, the manufacturer, often distributed through a marketing organization called an FMO, a field marketing organization, and sold by an agent. So there's three people that got to get paid: the insurance company, the distribution channel, and the sales agent. For example, there are 17 FMOs contracted between or beneath Annexus who have the opportunity to market the Annexus index annuities. But Annexus has positioned itself as a super FMO. And again, I don't even know what FMO stands for. It's the field marketing, what is it called? FMO. What do they say here? I forgot what they said with FMO. Field marketing organization or something like that. Yeah, I can't remember what they call it. I mean, that's all news to me, and I've been around for a while. All right, let's just the manufacturer. Oh, yeah, field marketing organizations, FMO, exactly. All right. Okay, so Annexus has positioned itself as a super FMO in that it works with a group of FMOs to distribute products. So there's another. Most fees, however, are not explicitly charged, but are embedded in the product's net annual profits, an estimate of which we will see below. There's no public information about the marketing fees paid by the annuitant to Annexus, the FMOs, and the broker. However, industry sources have told us that typically Annexus gets 2.5%. The FMO gets 2.5%, and the agent gets 7%. So the client is paying 12% in total marketing fees, and this was one of our motivations to understand whether an investor could still be well served by paying fees at those levels. It is our understanding that the typical fixed index annuity against which the FIAs we studied competes pays about marketing fees a little bit less than 12.5, about 8.5 to 9%. So, all right, let's wrap this up for this point one. So basically what they're saying is you got all these different layers. No one is doing this altruistically. They're all getting paid from somebody without question. You got let's just go back to what they said. You got the insurance company, which is a manufacturer. You got the distribution channel, which is the FMO. Then you got the agent. So now we have the insurance company, gives us a super FMO who defines it out to all these other FMOs who are also getting paid, who defines it out to their agents as well. So you can see where the fees start to pile up. So let's pause there. We'll come back and read 2 real-world examples of FIAs, and we'll chat with you here in just a second. So as always, if you like what you see, don't forget to subscribe. If you find this information helpful, let me know, because I love doing this. If you don't want to listen to it, that's fine. But, there are some people I'm hoping out there that finds helpful. But if you do find it helpful and you want to support the mission here at Heritage Wealth Planning, go to my blog at heritagewealthplanning.com. There's a little button down there on the very bottom of any page you go to donate. I'll be happy to take your money. I am a capitalist. So if you find value in what I'm doing and you want to support me, do that for sure. You can always donate directly on the YouTube channel. The button isn't very explicit, or it's hard to see. But if you can go up in the top right, there'll be 4 buttons: Amazon, Facebook, LinkedIn, and there's one for PayPal. And I'd be happy to accept your donation as well. Lastly, just by you being here and watching these videos gets YouTube algorithm to support me with putting more and more advertisements out there. So I appreciate you being here for sure. So stay tuned. We're going to do part 2, and we'll come right back and let you know in the 2 real world examples. Thanks now.